Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 8th of 2026. We'll start the chart pack this week. Obviously, we have a war going on, lots of studies and analysis being done on the potential impact to the markets, and a lot of analysis with regard to how long this might last. Offer this chart to you here. These are drones and missiles that are fired from Iranian territory or Iranian controlled territory, i.e., its proxies in the Middle East. Obviously, they've been firing on a lot of other countries where there is perhaps foreign military presence there. But you can see here that basically in the first week of the war, you see the level of munitions and drones declining here in the last few days with data current through March 4th. That's not to say that they're running out of munitions. It's just saying that we're getting a little bit more mature in this conflict, and certainly a supply of munitions is a question mark for, frankly, both sides in this case. And again, there's a lot of speculation over how long this is going to last. Seems to be some theory that it might last a few weeks without boots on the ground, which I think we all hope. But in any case, we'll talk a little bit about the energy markets. We'll talk a little bit about some recent economic data that I think is important and perhaps to be influenced by some of this, as well as some commentary on the investment markets. First, on the economic front, we'll talk about the jobs report. It was a bit of a negative surprise, so we actually subtracted 92,000 jobs in the month of February. You can see here that that was, in terms of its magnitude, kind of one of the more significant drops that we've seen over the last year, following a very prolonged period of labor market growth. So a lot more noise here lately. We did have a very good report in January, which seemed to make people feel a little bit more, perhaps complacent for sure, but positive in a more general sense. This is the average job gain over the trailing 3 months, and we would be negative if not for that fairly good print in January. Well, the jobs number last month, as I said, was below expectations, frankly, pretty weak, where we had seen a lot of support here in prior months was in the healthcare sector. In fact, in the chart pack last week, we showed you just how much healthcare has benefited job growth in the overall economy over the last year and a half. You can see that it was negative in the last reading, and you can see how all of these areas, construction, information, transportation, and whatnot, basically more than offset financial and wholesale trade activities. Here we have unemployment rate about ticked up a little bit. We've got basically 4.4%. Here you can see how it's tracked over the last handful of months and actually over the last couple of years, frankly, coming out of the pandemic. So we've certainly had an elevation of this. I'd say really over the last 3-4 months, we've been kind of stuck at that 4.4, 4.3 level. And again, more speculation over where that's going to go. Another interesting thing that I look at here is labor force participation rates. Those have come down a little bit. They're really kind of anchored, below the 63 level. And you could see that prior to the pandemic, we had much greater labor force participation, and we just really haven't recovered afterwards. And so you think about, the supply of workers in the workforce having gone down. That actually does have an impact on the unemployment rate, because this is part of that calculation. And so obviously I think the statistics would be a little bit worse if we had greater labor force participation. But as I think we'll see in some of the slides coming up here, what we have is just kind of a drawdown in demand for labor, not necessarily due to AI, but certainly not helped by AI. Here we have manufacturing employment that continues to slide. This is not a new phenomenon. Actually, we did in the aftermath of the pandemic when people were ordering a lot of goods remotely, and we did have some spikes there in manufacturing employment, but that has certainly come down to where that peaked before the pandemic, and looks like it's on a continuous glide path down. Wage growth is something we've also paid a lot of attention to. This is something published by Apollo, and with comments from Torsten Slot, their chief economist. We did have a tick up here in job switchers. So I think this is probably highlighting demand for those in the technology sector. Where we saw in the post-pandemic phase a real swing up in wage growth, particularly in service sectors, and we saw wages go up higher than for those people that were actually switching jobs, and just for everyone else. And you can see that that's kind of maybe reasserted itself. It could be a false positive, but again, maybe indicative of the demand for labor in a very narrow part of the economy. Announced job cuts due to artificial intelligence. This is from Dave Rosenberg's research group. You can see that continues to move higher, and even though it still, as a percent of the total, is still kind of in the minority, you can nevertheless see that AI is having an impact. Productivity growth, however, continues to move forward. Here we've got basically about 2.8% here in the most recent reading. You can see unit labor costs, as we were kind of like looking at here in the other in another chart, is moving a little bit higher, but we're getting productivity, and you can see here that we've had that for a number of quarters now. And again, this is a lagging statistic, so it gets measured after the fact. But you can see that there's very few instances here, with first quarter notwithstanding, where very few quarters where you have negative productivity. But by and large, I think the average, if you were to benchmark this, would be somewhere around 2%. And here is unit labor cost. The estimate was for 2%. We got 2.8%, a little bit higher than expected. Year over year is only 1.3 because we've had some weak prints here and we've actually had some negative trends. Again, the monthly data can be a little bit noisy. I'd say the year over year is a relatively decent proxy, but labor costs continue to move higher, and but at a rate that is now below inflation if you look at it on an annualized basis. Institute for Supply Management Services Purchasing Managers Index is what we have here. Got a few charts here because I think the service sector obviously is very important because it contributes a much greater percentage of our economic growth than does the manufacturing sector. So you can see that that's punching higher. Anything really above 55 represents relatively decent expansion. Anything above 60 represents exceptional growth. We're certainly not there, but we see new orders spiking higher after a multi-quarter trend here of continuous improvement coming out of that contractionary environment. Here we have backlog of orders that has extended itself. So again, another healthy sign from the service sector, and employment, which I think we've just got through talking about employment being, a bit softer than expected, and the demand for labor maybe being, a bit softer overall, with the exception of one or two particular industries related to AI. But as we see here in the service index, for employment, that's moving higher. Again, positive sign. Here we have Beige Book. Beige Book is published by the Federal Reserve board. It represents a synopsis and summary of economic conditions in each of the Federal Reserve 12 districts here. And we've got that still in negative territory. It does represent a little bit of an improvement from the prior quarter, or excuse me, the prior quarter. And then, but we do have, an elevated response rate and mentions of uncertainty within those particular reports. This is a survey from University of Michigan. This is surveying individuals, consumers, on whether their financial situation is worse than a year ago due to higher prices. And you can see that remains elevated and has for a number of years. And so this is what I'll call kind of the lower leg of the K-shaped economy here. This slide, we have weekly business formation, and this has really exploded. We've been watching this for a number of years, and you can see the pace at which we were increasing that new business formation before the pandemic, and then obviously after the pandemic has really expanded. You can see here, this is a presupposition from Apollo that AI is having something to do with this, and I think it is true. I will say that when you look at business applications on the whole, a lot of these represent very small businesses. I mean, less than 5 employees. And so you see a lot of people moving out on their own and starting their own businesses or consulting practices. And I think AI is certainly inspiring a lot of people to open up those types of consulting firms. We've got trade here. We've got export and import prices. We've got export prices moving higher, import prices actually moving a little bit lower year over year, month over month. They were pretty much in line, and export prices here were well above the expectation here. And you can see that they have moved higher for quite some time. This has, I think a lot to do with tariffs. And then on the import side, you've got some tariff impact, but it seems to be somewhat muted at the moment. Here we have some commodity prices. This is going to be something that I think is going to be a theme. We see basically some transitions between certain sectors of the economy to more of the kind of the supply and the material sectors. Obviously, we've seen a pretty strong rise in copper prices, which I would say have been maybe potentially affected here by the shutdown of the Strait of Hormuz. We've got Middle Eastern supply, which is constrained, there are constraints in getting that out of the Middle East because of everything that's going on. But we also have aluminum prices that are higher. This is important for construction, certainly, important for the overall commodity basket. And I think, as we'll see in a little while, that there is perhaps a rotation from technology, which are the users of these resources, to the basically the supply components that help to create create those services like energy and materials. All right, now we're going to switch to oil prices. Obviously, this is something we've been watching for the last week. In fact, these prices, this is actually not necessarily showing Friday's data, but it's important to realize that we did have prices spike above 80 to 85 on Brent, and so obviously the war is having its impact. On this chart, we have the importance of some of these major passageways, and certainly the Strait of Hormuz is very, very important, as it's highlighted here. First is the Strait of Malacca, which is the passageway which connects the Indian Ocean with the Pacific Ocean, and it handles, as you can see here, almost 25% of global seaborne trade. And in this case, we're talking about petroleum, so it's about 24% of daily transit volume of petroleum. But right behind that is the Strait of Hormuz, which is, of course, at the center of the Iranian conflict, and because of its proximity to Iranian ballistic missiles and drones, etc., is effectively shut down right now. And to that point, we can see here very clearly that both inbound and outbound supplies have been constrained considerably, basically down to a mere halt because of the conflict. So continuing the conversation regarding the Strait of Hormuz here, this is a chart that shows you where those barrels are going. And you can see a large amount of that is going to China. So this is, the oil that moves through the strait is very important to Chinese consumption. You can see that India also receives a fair amount, as does South Korea here, and of course Japan, which itself imports more than 90% of its energy needs. And then to a lesser degree, some of these other folks, including the United States here, which is basically energy self-sufficient at this point. So, and then this graphic here, roughly 30% of all oil trade was transported through the strait, as we actually just saw in a earlier slide that also included the volume that goes through the Strait of Malacca. And we can see here that the cost of transportation is moving higher quite a bit. And you can see that prices were already moving higher really as a result of tariffs, et cetera, before the Iranian war, as we'll call it. And then basically we went from somewhere around 10 to 20% of the futures price. So something else I find pretty interesting about the energy markets right now is the fact that our strategic petroleum reserve is at a relative low point in a time series that goes back to 1985. You can see here, I mean, we're basically about 350 million barrels, and that was basically double that for the bulk of at least the last decade, dating back almost 15 years. And we've been consistently drawing that down. And the argument in the article that this was attached to was, why would you want to start a war that would impact the supply of energy if you were not, if you hadn't already, rebuilt your strategic energy reserve? And so I can't find fault in that argument. But this is very interesting because this is generally how you control the consensus feelings about higher oil prices. It is by releasing barrels from the strategic reserve when you have these price spikes, and then that enables the psychology of the market to kind of settle down a little bit. And there are some real tangible supply supply assistance that helps to maybe lower prices or temper price increases. But if you're down to 350 million barrels in your SPR, your ability to do that is much more constrained. So a lot of time has been spent trying to figure out what the impact of this is going to be on the economy, and namely, the spike in oil prices. I'll certainly say that that military and geopolitical issues in the past typically do not have a long-lasting impact, but it's always interesting and a valuable case study every time we have one of these things to analyze. Well, what could be the impact if all of this would be sustainable? And to say if we had oil, in this case, move up by $50 a barrel and stay there and not come down, which is generally not the case. But if it did stay sticky at that higher level, what would be the impact to inflation? So you can see here that basically, we would have, less of an impact, but certainly positive and not insignificant, would be about 0.7% of inflation. And then basically we'd have a 1% impact to overall inflation from higher energy prices if that were sustained. And again, the Fed looks at core personal consumption expenditures, and we spend a lot of time here looking at core CPI, which strips out the energy price. But this would be kind of looking at what's the impact to just the straight up headline consumer price index. And you can see that that goes down over time as these increases are anniversaried. Again, this is supposing that they move up by $50 a barrel and they stay there, which is very rare. Here we have some analysis from Goldman Sachs looking at the impact of a temporary oil spike to $100 a barrel on various parts of the world, various countries. Here we just talked about the U.S. Being basically in Goldman's estimation about 0.2% of GDP degradation over the next 12 months, and you can see the impact falling a little bit more heavily on other areas, particularly Europe, India, and with the global impact being somewhere close to around 0.4% if you get that price spike. And basically, they're taking, their baseline oil forecast here is assuming something a lot more modest in terms of its overall impact, but from a global standpoint, still negative, just not nearly as much. So on this chart, we have gas prices. You can see here that they have moved up to $3.30 a gallon on a national basis. You can see the Iranian conflict here. We had gas prices that were moving up in a slow, methodical rate dating back to January, because we are getting a little bit closer to the shoulder season and just really a couple of months here away, 2.5 months or so away from the beginning of the peak driving season. But already we're in a level that is going to start to pinch a lot of consumers out there. Looking at the energy futures curve, we've got Brent crude basically in what they call backwardation. That just means that near-term prices are much higher than longer-term prices are in the futures market. And this is a sign that the market feels like it's going to be back into better equilibrium in the future, right? That right now we've got this Iranian conflict that's basically causing a lot of discomfort and disruption in supply. You can see that just basically in the span of just a few days that futures price, as we were just showing you, has moved quite a bit higher. But you can see that we have the same level of kind of like flattening over time in the futures curve. Again, the thought that the market gets a little bit back to normal after a short period of disruption. So something else I've been spending a lot of time on here is asset flows. And, this is something, as I've mentioned several times in prior chart backs, that I would not have expected. And that's the continued net positive inflow into U.S. assets. And in particular here, we're looking at equities. And so we've had a significant move into risk assets in the U.S. from foreign purchasers. And this is despite the tariff announcements. This is despite, the Liberation Day back in April, et cetera, et cetera. And you can see that the overall amount of assets coming into the U.S. has moved to basically a new high. And so that includes here, we've got corporate fixed income. We have treasury bonds and notes, and then we have government agencies up here. But the biggest component and the biggest agent of change in this data series has been the net positive inflow into equities. Now we'll talk about the equity markets here for a little bit. This is a chart, again, from Apollo that I find really interesting. It just shows you that the single stock implied volatility premium is much higher. It's basically the fact that this is moving higher tells me that single stock volatility is is much higher than the overall market volatility. And when you're talking about like things like idiosyncratic risk, that diversification is really important here to try to minimize the amount of risk that you have in a portfolio due to any one, two, or three positions. That diversification in an environment where single stock volatility is elevated is going to be very, very important. Average tenure of companies in the S&P 500 index is something else that I find really, really interesting. And so, back in 1958, when we had the Nifty 50 and Dow Jones was dominated, and the S&P 500 was dominated by, more industrial related companies, et cetera. You had a very long tenure. I mean, you could expect that the same stocks would be in the index for a long time. And that has declined over the years to the point now that we're basically about 1/4 of the length of time in the index that we had in the late 50s. And think about the average tenure of S&P 500 companies is only 15 years. That is a symptom of not only mergers and acquisitions, but also kind of changes and rotations in areas where Standard and Poor's feels like they need to have perhaps greater representation. So this does maybe create some longer term volatility just in terms of the index construction, but it is very interesting how it is literally 1/4 of the tenure on average that we saw back in the late 50s. Another thing I find really interesting is the prospect of a rotation between sectors. And we've been talking a lot for a number of years about the kind of the breakout of the technology sector. We've talked about, even today, the concentration of tech within the index, and also the relative underperformance of some of these other kind of other sectors that frankly provide the material inputs that allow technology to work in terms of energy and materials. And so we see here very clearly that you've got this, this divergence over these number of years where energy and materials have underperformed relative to technology. Now, we've got these little fishhook changes here, and I'm not going to make the bold assumption that these are going to be trend forming, but I think it is important to notice that that there is the potential for this to reconcile at some point in the middle, and that the market will give more emphasis and value to those parts of the economy that are supplying the materials and supplying the energy that allows technology to work. We've talked a lot about the higher commodity prices in terms of copper, just as an example, but other precious metals and industrial metals as well. And so these are very important inputs that may become supply constrained. And if that's the case, then their prices will go up, and obviously the companies associated with them should also improve as well. And so, while I'm not going to assume that this is going to indicate the turn of the tide, I do think it is symptomatic and emblematic of a divergence, which I think at some point will reconcile to the favor of investors that are paying attention. Now, in an effort to do that, however, it's going to entail a little bit of volatility. And as you can see here very clearly, you've got the weight of the largest 10 stocks in the S&P 500. And you can see that that number is well over 40%. And I think we've seen it almost as high as 45%. And, that's a very high concentration. And you've got the next basically 40 stocks in the index that have a weight of about 24%. And you can see that this is also witnessed a divergence in the fact that these 10 stocks, and many of which are these technology firms that have outperformed, as we saw in that last slide. And I do think if there is a reckoning or reconciliation that happens where maybe some of the the lagging areas begin to receive greater support, and we tend to see more of a broadening out in the markets where greater value is being ascribed to these stocks. That's naturally going to create some volatility because of the influence of these stocks. And so, if you take some multiple expansion off the table here and maybe have multiple contraction, which I think is a very real scenario for 2026, then that just by itself is likely to create some volatility. Now we'll look at that overall volatility index. You can see that it has gone up each of the months of the year. And also here that if we look at the average year in the stock market, March has historically not been a great month. Just as like August is kind of a difficult month, October is generally a difficult month, and then we generally end on a good year. And the average this over the last 20 years is about 10% a year here. But again, March usually a weak month in the year for stocks. Now switching over to fixed income here, we have the Treasury curve looking at it basically at the end of this week relative to the prior week. And you can see here the prior week in the dotted line. We can see the most recent line here in this pink line. You can see that interest rates have moved up in really kind of a unified manner. So we really don't have any change in the slope of the yield curve with the exception of kind of we're anchored here on the ultra short term rates. But you can see that the rates have moved up almost uniformly across the curve, and this is a symptom of bonds selling off in an environment where there's a lot of uncertainty. And just to follow up with that last point, that last chart, you can see here both on the 10-year Treasury as well as the 2-year Treasury. We can see here basically this is the and you look here on the 5-day change. This would be more representative of kind of like that consistency that we saw in that last chart. You got 20 basis points move in the 10-year Treasury, and that's a yield move higher. And you can see here very similar 20 basis point move in the 2-year as well. Here's another aspect of the fixed income markets that I think is really important to mention here. This is the market implied short-term interest rate changes. And this is looking at it relative from just a week ago, again, February 27th here. And you can see that basically what we're looking at now, the market policy rate change is about half of what it was. And so particularly, you look across this spectrum here, and it's really because, what we're now talking about is this real conundrum that the Fed is in the sense that they have a dual mandate, right? So they have to try to create an environment of stable employment as well as stable pricing and inflation. And so that dual mandate is very difficult to achieve at a time where you have some inflationary pressures potentially from energy, as we've seen already, but also have a softening labor market. So on the one hand, you might be inclined, and I think there have been various points over the last year where the Fed has been more inclined to want to tackle the employment issue and let the inflationary issue slide because inflation was kind of sticky, but it seemed to be stable to maybe slightly moderating. Well, if that changes, you might have an environment where you have that softening labor market that you want to tackle. And if you reduce rates to tackle that, you might exacerbate the inflation problem on the other end, which is something you absolutely do not want. But in turn, if you raise rates, and I think there is in the range of outcomes for the next 12 months, there is a relatively modest scenario where I think you could argue the Fed should raise rates. But if they did that in an environment with slowing labor, that could exacerbate the labor problem too. So I think net, the feeling is that there's less of an impulse for the Fed really to want to do anything in this environment. And generally, the Fed is very recalcitrant to do anything in a wartime footing, where you've got some of these, what I'll call kind of like short-term stimuli on markets like energy prices, for example. So obviously we'll have to monitor this, but for now, I think it's safe to say that there's less of an impulse to necessarily lower rates, certainly not by the rate that even a week ago before this Iranian conflict. Here we have monthly immigration figures. This I find particularly interesting because we have really a net exodus from the U.S. right now. Usually we have net positive immigration from outside our borders, i.e. entry, which is in the green line here. And that's usually offset to some degree by exits. But right now, you say our net entry is negative and has been since January of this year, largely due to immigration policy. So the last thing I want to address is really private credit, and you can see a lot of the leading private credit firms out there have varying exposures, of course, and in particular, the software exposures come under a lot of scrutiny now with AI and AI displacing the need for certain software platforms that have received a lot of, frankly, a lot of private debt funding from some of these large issuers and from other issuers as well. And so, and that this whole space has come under a lot of scrutiny, and a lot of these funds are trading significantly below their net asset value just because of the perceived risk and the sell-off. And so you can see with Texas Pacific Group about 11% exposure to software, and you can see other folks here kind of in the mid to high single digits, and then Apollo down to 2%. This is why this whole group is selling off right now, is because of the fear that there's going to be a lot of displacement in software due to AI, which is going to cause credit stress on this part of their portfolio. That's all we have for this week. I hope you have a great week, and we'll talk to you again soon.